think the reality will hit people. And a lot of people don't like to invest in, let's say, silver futures or call options on SLV, or, they just want to buy miners. It's a stock in their stock portfolio, and they're haunted by certain memories that are false and also brief, like that 2008 collapse in the miners, which happened to concur with the S&P that month.
And if you stop and you look at the chart on the long-term gold buying of central banks, what you will notice is this very long period of time where they were selling and leasing and doing all of this funny stuff to control the price that way. But they actually started shifting that behavior in, what year was that? 2005. 2005. It is a huge debt problem. And you can see this in the long-term bonds, because it really is. Look, this is a con game, and every con game requires two key things. Confidence is number one, and new money is number two. And silver is really like the fuse. When confidence is ebbing, you will always see silver move first. Gold is the anchor. And so you notice that silver is a lot more volatile because it really straddles two worlds between the industrial and manufacturing world as well as the financial world. And while gold does that as well, not as much, not in the same way and as much as silver. So silver is the fuse. And what this rapid rise in the level of volatility in both of these metals are telling us is that that confidence is at an end. And when you look at the charts on it, that's why I like being a technician, because it doesn't matter what you're looking at, it all works the same. And so when I'm paying attention to what's happening with the confidence levels, we are a hair's breadth away from breaking to new lows. And as soon as we do that, that's when I'll feel more comfortable saying, okay, now the clock is ticking and we should see hyperinflation really start to rear its ugly head. I mean, I wish I didn't have to say that, but really, when the system died in 2008, and there are repeatable patterns, and so I'm going to throw some of those out there for you and see if it doesn't sound familiar, because around a currency reset, and what that means is you're changing from one system and going into a new system. And so the system has to reset itself, which is actually what that overnight revaluation is. But the patterns that you see 100% of the time through these, you will see the level of volatility in the stock markets. You'll see high inflation. You will see wars, right? You will see issues around civil rights. You will see issues around women's rights. You will see issues around energy, okay? And part of this is about creating a lot of chaos, because then you're looking over here, you're looking over there, and your friend's looking over here, and nobody puts these things together. And a chaotic mind does nothing, which is what they need you to do. And if you stop and you look at the chart on the long-term gold buying of central banks, what you will notice is this very long period of time where they were selling and leasing and doing all of this funny stuff to control the price that way. But they actually started shifting that behavior in, what year was that? 2005. 2005, a full 3 years before the financial crisis became obvious to the public. What does that tell you? And now the level of gold buying that's happening on a global basis from central banks is, for the fourth year in a row, at historic highs. And there was just a teeny weeny bit of less buying for the full year of 2025. But guess what? 2025 was also the highest level of gold and silver buying ever. And that it was the public, to your earlier point, it was the public that has stepped in to start buying. Because all we ever hear is how the public isn't. But here in the US, with all these big box stores like Amazon and Costco and Walmart, these are big, huge box stores. They are not gold and silver dealers, but they're selling gold and silver. And these usually, especially Walmart and Costco particularly, go for their clientele are the average Joe. It's just the average person on the street. This is not a wealthy individual. It's an average person. They're not going to carry that if they're not selling it. They're not going to carry it if there isn't the demand there. So I think that Wall Street does not want us to understand what you and I know from our experiences with the level of demand, but this isn't something that just happened. This is something that has been building.
I think this is, well, we favor the miners over gold, and there's a level, though, that we haven't broken through yet. What we do is we measure the XAU index, which is the Philadelphia Gold and Silver Index, but it's miners, okay? It goes back to the 1980s, so you get some history on it. We plot it in its relationship to an ounce of gold. And if you do, and you go back to look at 1980s, 1990s, 2000, until 2008, for several decades, if you divided XAU into an ounce of gold, you'd end up on average, above and below, a range of 25%. It reached up to 35% at one time, and its lows during this multi-decade period, when you plot the charts like a box, okay? We're in the 17-18% level. You broke through that in late 2008, and you collapsed that spread, meaning the value of the miners to what they get out of the ground, okay, to 4%. Now think about that. Something that had lived at an average price versus the thing it gets out of the ground, gold or silver. It went to 4%. I mean, we don't need miners. We need gold, silver. We don't need the miners, right? Okay. That chart is screaming at you, hey, you think I'm going to go to zero? And so since 2014, you can plot a range on that same relative performance chart. Beautiful little box. And it's like from 5% up to 8 plus, 5% up to 8 plus, 5% up to 8 plus again, intra-month, last month. Right now it's back below 8%. But if you get much above the top of that range, and we think this third assault on the upper end is probably the one that's going to break out. So it didn't break out last month. But you get up above the top of that little box. Again, visualize that as a chart. When you break out above that beautiful technical range, there's nothing to stop you, technically speaking, in terms of the value of the miners to the metal they get out of the ground, until you get up to 17 or 18%, which is to say, to go bump the bottom of the floor that had existed for decades. So you go from, boom, you could double the miner's value relative to gold. And I strongly suspect that's about to occur and will show itself this year. Probably the breakout I'm expecting next month or so of that spread. And when those spreads break out, like the silver did back in the November close, look what happened to net price over the next 2 months. It went berserk. Expect the same from the miners. So you're right, And there's 4 miners coming up with silver miners coming up in the first 2 weeks of February with earnings for the biggies. That report will be based on what? Fourth quarter, right? Okay. Go back and look at a silver chart. Where was it during the last quarter of the year? So, that's what they get out of the ground, therefore their profits are, et cetera. Average $50, okay? Somewhere either side of 50. Right now, so far in the first month, our average price is, well over 100 average price now I'm talking. And if we stabilize here and then sort of work our way back up so that February and March we're back up toward 100, 120 again, then your average price for the new quarter is going to be about 100. Okay, double what it was before. So the guys who look at earnings and say, wow, this miner's making a lot of money at $50 last year. Golly, gee, that's really good profit. Because remember before when we were at 50 in 2011 and 1980, you collapsed from it quickly. You didn't stay there. So you never got an average price up there. This time they had an average price in the fourth quarter of $50 or so. Wow, so the earnings have to look real good. Imagine what they look like if this quarter has an average price either side of 100.
Yeah.
So if you're looking at that as a factor, whether you should tell your clients to buy silver miners or gold miners, you don't have any excuse now not to say yes, based even on the fourth quarter earnings, much less what looks like could be evolving for the first quarter. You get the point. Yeah, There's a fundamental reason, too. They're underpriced in relation to that which they get out of the ground.
I mean, all of those things that we just talked about, but it really is about the level of inflation, because that's the job of the central banks, is to regulate the rate and speed of inflation, not fight it. That's just garbage. Look, if you have to borrow money to print this, well, then what does that mean? That means you now have interest on that debt that you have to pay. There, my friend, is your inflation. This is not rocket science. But what the central banks are also tasked with is what's called price stability. Now, if you and I hear that term, we think that that gallon of milk stays the same price over time. That's a stable price. But what the central bankers mean when they say price stability is inflation at a low enough level that you, even though you might notice it a little bit, you do not change your spending behaviors. Rather, what you do is you take on debt, right? But does that really help you if your income does not keep pace with that debt? And so, really what we have right now, and remember, we've had 15 years of zero interest rate policy. All of that debt, so all of the money printing, plus any mortgages, any student loans, any any debt, credit cards, any of that debt that was issued in that 15-year period is underwater. I like to use this as, this is my sterling silver chopstick, right? So this has value. I can barter with this. But if this is interest rates, and that's the principal or the market value of the debt. And let's just use bonds just to make it easy. That's the market value of the debt. And this is when the bond was issued. So that means this would be short term going all the way out to long term. Okay. So we had 40 years of this. Interest rates that were being pushed down. You can see it on the charts. And so then the market value of those bonds would go up. So even if you had some defaults and you were in a fund or something like that, you didn't notice that. You didn't see it. It was hidden. But in 2022, when the global central banks started raising those interest rates, when interest rates go up, the value of the market value, the bonds go down. And what have we seen? Starting in Japan, but in Germany, in the US, everywhere in the world, those longer term government bonds, interest rates are spiking on them. And that indicates, yep, a loss of confidence in their ability to service this debt. Because these government bonds are supposed to be risk-free. Well, why are they risk-free? Because they can print the money to pay you. But when that money, to your point, has absolutely no spending power, what do? And that is why the system must reset into a new system. And that means they have to reset all of that debt. In other words, how do advanced countries do it? Advanced economies do that. They repay that debt with dollars, whether it's the Aussie dollar or the US dollar. They repay that debt that has zero value. Zero. And people can't believe that that could possibly happen, which is one of the things they knew. People marry the legal money in the state. But again, I would send you to the purchasing power chart at the Federal Reserve. I don't care where you are in the world. Use this because most other countries don't publish it. And that's because the US dollar is still officially, the world reserve currency. So other currencies get judged against it. But if you go in there and you look on that left-hand axis, you'll notice that on the bottom, there's a big fat zero. Why is it zero? Why is the Aussie dollar's value zero? Because it doesn't cost anything to create. It doesn't take any effort to create it.
I think the reality will hit people. And a lot of people don't like to invest in, let's say, silver futures or call options on SLV or, they just want to buy miners. It's a stock in their stock portfolio, and they're haunted by certain memories that are false and also brief, like that 2008 collapse in the miners, which happened to concur with the S&P that month. But at that point in time, the miners, relative to gold, were actually breaking down on that spread relationship I talked about, where for 3-4 decades they'd been average 25%. Well, in September of 2008, they broke below the bottom of that whole multi-year performance range versus gold. This time it's just the opposite. They're cheap in relation to gold. They're cheap in relation to the stock market. They're cheap in relation to everything. And people have just been dismissing them. And yet when you look at the earnings based on, what's the average price of silver last quarter? What's the average price of silver now this quarter, or gold? How can you dismiss them? Well, finally, portfolio managers and the financial planners and so forth will have to say, yes, Mr. Jones, you're right for asking me about the miners. I kind of agree now. You can put that in your portfolio. Why? Because the earnings look great. So there may be a whole new wave of public buying. That's what I'm saying. Like especially when these next earnings reports come out for the miners in February, that start to turn heads. And if anybody does a relative study of miner value to the metals, geez, it's ridiculous. You want to buy cheap? Buy cheap.